Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at our UOA Today trade from one day later, right, from Thursday to Friday. So anyone who wants can take a look at Thursday's video where I suggested a couple trades to capture this huge spike in implied volatility, doing it in a somewhat neutral fashion, right? Actually did one of them that we'll take a look at here. Lo and behold, things that I thought were actually getting a little bit overdone got way more overdone on Friday, especially from the IV perspective. So we'll take a look at how that portends to the trade. And maybe if you haven't gotten in, a even better opportunity to take advantage of what is getting to be just utterly extreme run-ups in call buying, especially driving up implied volatility. So let's jump in and take a look. First of all, here's the scanners from Friday. The original video had the scanners from Thursday where Qualcomm was number 2 on the list, now still hanging out right at number 7 on the list, but massive repeat volume, especially call buying. We'll see what's happened with the call prices in a second here. Over 600,000 contracts traded Friday versus about 75,000, and that is with the big volume that we saw. So that average has gone up a little bit. So 8 times the average volume. IV level now still at 100%. On Thursday it was at 100%, right? Brand new high. Lo and behold, Friday exceeded that. We'll see just how much in a big way. Here's the scanner I built on Thinkorswim. Number 2 on the list is the Qualcomm May 250 calls, right? As far as 32,000, almost 33,000 trading. So people rushing in to buy these calls are very much price indifferent. We don't mind taking advantage of the fact they're willing to pay almost anything, and that we'll see on the chart here in a second to get into the trade. We'll take advantage of that. Do a dual trade selling the calls and puts both, right, to take advantage of this huge run up in implied volatility, which, as we know, does not last forever, especially spikes tend to revert very quickly. So here we can see the IV Friday again, getting to an extreme, even higher levels, right? From Thursday to Friday, you can see that big run up across the whole term structure vol, massive run up. Here you can see basically a look back over the past 20 days or so, generalized IV. You can see here was earnings, right? IV at 52.50, then the normal vol crush. The previous video we posted earlier talks more in depth about this, but now you're seeing this massive lift. You can see from Thursday to Friday, IV running up basically 10 vol points. Note too here that the put IV, right, is now trading at a big discount to the call IV. Normally, when we started or took a look at it, normally puts tend to trade at a slightly higher IV, and that's normal across almost every stock, right? But because of that massive speculative call buying, we're seeing that the call IV trading at a huge premium to the put IV. This does not last forever either, so certainly the speculative fervor getting in, normally it ends not too well, right? Here you can see the run up on Friday, right? The June, which we haven't done the June trade we talked about in the previous video. We did do that January running up over 6 vol points, which for longer term options is a lot. I pulled off the 360-day 30 delta IV, as we said, over the past 2 years. If you take a look at the previous video, here's where it was, right, on the previous video, the IV 360, right, closed at, about 52 and change, right? You can see that now we're approaching 58, a massive run up. You can see by far the highest IV level over the past 2 years, no question. Here's a shorter term 6-month look at both the calls and puts, right? And you can see here again was the IV on Thursday's close, right? You can see everything skyrocket. This is the call IV. The put IV was down here, but the calls now, as you can see, trading at a massive premium to the puts. It hasn't happened. Here's the puts in purple, the calls in green. You can see the puts normally, right, trading at a premium to the puts from an IV perspective. That's totally normal, but now we're seeing the calls off the charts running high, speculation certainly coming in. So actually did a trade to take advantage of that, a huge run up in IV, as we can see here, as far as the strangle, right? So I went out and simply did the January of 2028, right? And here's the actual trade. 2028 selling the 200 put and the 300 call, right, on the opening on Friday. So basically a minute into trading on Friday, was able to get $70 for that trade. The previous day it had closed lower, right? It had closed at 69, but because the stock was up a little bit, and more importantly, IV up a heck of a lot, right? Able to sell a 48 IV, right? Generally, before that trade, as we said on the previous video, trading well under a 48 IV. So certainly capturing a nice little pop on IV. Deltas, as far as deltas, net deltas, 10 deltas net short, selling a 42, selling a negative 32 on the put side. So it's 10 deltas net short on Friday morning on that trade with the stock at 212.83, right? Got $70 of 48 IV. Let's fast forward to Friday's close. You can see that that same strangle, right, closed at over $76, right? We'll take a look in a second what led to that. IV now well over 50. So I thought I was doing good selling it at 48, but now it's well over 50. So the comparative here, that trade closed at a negative 16 delta, right? When I did the trade, as we said, I was negative 10 deltas. So certainly a little bit short from a delta perspective. The stock did move up a little over $6 from when I did the trade, right? The stock was at 212.83 when I put the trade on, right? The stock opened higher, closed at 219.09, right, on Friday. So certainly had a little bit over a 6-point gain, right? With about a negative 15 IV, generally started at negative 10, closed at negative 16. So you expect the loss on the trade to be a little bit less than a buck, but the actual loss was over $6. Why? Because IV moved from 48 to well over 50. So over 5 points of the loss was due simply to that run up in IV, right? There was no time decay and we're short theta, right? Really nothing much changed. The stock was up a little bit from when I put the trade on, right, at 212, right, 83 stock price. So yeah, a small move higher in Qualcomm, but that huge run up in IV, right, as we said here, this massive run up in IV led to that mark-to-market kind of negative effect, and now the calls trading, as we said, at a massive premium, right, to the puts as well, indicates speculative fervor getting a little off the charts here. So I pulled off some theoreticals, simply did, what if we ran the stock up another 10 points or so, right? But dropped the IV back a little bit, right, to 40, where it was basically before Friday from Thursday's close. We can see the calls would have been roughly unchanged if we get that run up to 230 and a drop in IV of only 5 vol points here, right? Not big. And the puts, right, would have basically dropped 8. That trade would have been about break even with the stock running up higher, right, based on IV reverting somewhat. So still looking for that reversion somewhere, 5 vol points would be from here to here on the calls, here to here on the puts, right? So not looking for anything down here. That would certainly be even more beneficial. We have all the way out to January of 2028 for this big spike in IV. As you can see on the 2-year chart, has never been this high before, right? So it can't stay up. You can see previous spikes, as always, are met with a pullback. So hopefully provide some insight into how we go about identifying the trades and how being too early can at least show a mark-to-market loss. But from a price perspective, the stock closed no problem at all, right? We're short the 300 call and the 200 put. The stock, as we said, closed, not too badly at all as far as 219.09, right? So we're still fine from a price perspective. It's just that IV actually went higher, believe it or not. How long that lasts, anyone's best guess. But again, position sizing accordingly, giving yourself plenty of cushion, right, and being able to stay with it. Because the one thing we do know about IV, that's the one kind of financial aspect that always reverts. So until next time, as always, here's the good trading. Take care.